So the markets have started to correct, and this on the back of initial fears of a rise in interest rates. We first look at the hourly chart of the S&P 500, where we can see that following a long period of low volatility at high levels, the markets accelerated down at the end of last week. We can see that we reached initial oversold conditions, but that our trend indicator and target indicator is still leading us to think that over the next few weeks we could retest towards 2100, possibly below towards 2090. That said, the daily is still positive. As we've been warning over the last few weeks, we've had a breakout to new highs in July. That at some point we believe that this breakout should be retraced. And we believe that this is what is happening at the moment. That said, our long-term projections are still positive, and we believe that we could reach up to 2300 over the next few months. If we do take a trend line from these two bottoms, it pretty much brings us towards 2080. That is quite similar to the support zone that we have seen on the hourly. The weekly is still heading up. Following the correction down during 2015 and early 2016, it had its breakout, and we believe, although we do see some stress here over the short term, we believe that it could make it higher because this stress is not confirmed by an overbought condition. We believe our risk index could move higher over the end of the year, possibly into 2017. Our targets have been reached, but they extend from a very long time in the past. And in this perspective, we believe we could envisage a second level of targets, or impulsive 2 targets, which possibly could lead us 15 to 20% higher. Putting the 3 into perspective, we could see that we are still positive on the long-term weekly chart, still positive on the daily chart, and that we're in a correction on the hourly chart, which doesn't seem quite finished. That calls for potential intermediate top in what is still a long-term uptrend. Now, one of the reasons for the correction last week were initial fears of a rise in interest rates. And we had quite hawkish statements from the Fed's officials about 10 days ago. You had new Fed officials coming in with more dovish remarks since then. And you also had the ECB, which did not extend or did not lead us to believe that it will extend its quantitative easing program beyond spring 2017. Well, interest rates have started to react a few months back. And we look here at the Treasury notes 10-year future contract. And as you can see, it has had a very strong uptrend over the last few years. It has now reached its targets. It is at stress on our envelopes. They are touching each other, and it has reached overbought conditions. We believe that this could be quite an important top and trigger several quarters of consolidation down. Now, if we look at it on the medium-term basis, on a daily chart, or the perspective over the next few months, we could see that this correction down is moving lower into our corrective support zone. We believe that it could find that support towards the 130 level. That said, if our projection is true over the long term, it may over the next few months accelerate below this corrective zone and possibly initiate a longer term move. At the moment this is not the case, but we're still moving lower and we still have potentially another towards 130, possibly towards 129. The hourly chart is also moving lower, and we could see that it possibly has another week to go, and it could reach also similar targets towards 130.80, possibly down to the low 130s. Now, in such an environment, at the moment, we do expect that the uptrend on the long term is exhausted, that we are in a correction down which is slowly getting towards an initial support on our daily chart, and that this initial support could still be a few weeks away on an hourly chart. Now, looking at the euro, in such an environment, we would probably expect the dollar to be quite strong. Yet we do believe that the euro downtrend is possibly getting towards exhaustion. We've seen the very strong move in 2014, 2015 be corrected and not being able to create new downside momentum. Our projections are still leading us towards below 110 again, possibly down to parity. Yet our risk index is slowly getting oversold. That said, we do believe that this downtrend may be coming into trouble. That might be confirmed on our daily chart, which is already heading up. It is showing that it could make it towards the 116, 119 level over the next few months. Our risk index is in the middle of the range and not yet overbought. We do see a bit of correction down over the last few weeks, which is in sync with the correction down in equities, yet it has been fairly tamed. In this respect, we believe this is a promising picture on euro-dollar. Looking at the hourly, we could come to similar conclusions. We did see a sell-off on the back of the sell-off on equities late last week, but it has since stabilized. And we're slowly getting into oversold conditions on an oscillator. So although this correction down could last a bit longer, it has been fairly tamed for now. Looking at it over the 3 time dimensions, we see an exhausted downtrend, which could still move lower, but this is becoming more unlikely every week, and a daily and hourly, which are already positioning themselves in an uptrend. Now looking at gold in this environment, gold is reacting up on the back of the correction down in the dollar and commodities, which have been quite strong. Yet we believe it's an early stage defensive commodity. And if the cycle does accelerate, meaning that interest rates do rise further, we do believe that it may go not much higher over the next few quarters. Indeed, it has reached its corrective target and is hitting strong resistance. In this respect, it would now really need to move below 1433 to confirm that it could make it much higher and towards the levels that we saw back in 2012, 2013. At the moment, we believe this is quite difficult. I mean, on the daily chart, we've reached exhaustion. We've pretty much reached the targets, slightly below 1400, and we're at stress on our envelopes. Our risk index was also overbought. We've been correcting down since. Our hourly chart does seem to lead us to believe that this correction should continue over the next few weeks. Our price targets are leading us slightly below 1300, possibly into the 1280s level. Our risk index is not yet oversold. So we believe that gold has reached an important resistance zone with these long-term corrective targets, that it's pretty much exhausted on the daily, and that it's heading down on the hourly and possibly for another week or so. In the general context, if we want to see a strong bull market in gold, we really need to make it back above 1433 to accelerate. And this is not the case yet. Thank you very much.